Wow, more than 1 week after this crazy storm we had here in Miami, we're still seeing sights like this, guys. Look at this tree. It uprooted this giant tree for who knows how long this thing has been here for. And it's not even the only one over here in this park. You can see one way over there. Look at that. Same thing. Uprooted that one over there. You got that one over there with a bunch of downed branches. Didn't actually fall down, but wow, what a storm. It didn't seem like it was as bad as it was, but most of it took place at night. So I guess, you don't see a lot of the damage until the next day, and holy moly. And speaking of holy moly, check this out for holy moly. You have more and more banks and lenders starting to quit the mortgage business altogether right now because the volume is so low for the amount of people getting mortgages. Now, we talked about a few weeks back how a lot of people that work in the mortgage business are getting fired or being laid off, things like that. But this is yet another angle on this, because this is entire lenders or banks refusing to write mortgages anymore. So that is a huge shift, guys, versus what we saw just a few years ago when everybody and their mother wanted to give you a loan to get into real estate. And now you have more and more companies than ever walking away from it. It's kind of funny how just in a few years that dynamic has got flipped upside down onto its head. Over in New Hampshire, the Bank of New Hampshire has stopped taking applications for any residential mortgage and consumer loans after laying off 19 people on Friday last week. But the president insists that things really aren't going to change much for their clients. Of course, they say, oh, this has been in the works since the beginning of the year. We're going to continue servicing all of our clients with our deposit products, no problem, or our wealth management products. So we'll still take your money, but we're not going to give you any money, is essentially what this bank is doing. They're done lending. And it's not even just mortgages, as you can see. It's mortgages, it's consumer loans, and basically any type of loan you would get from a bank. And of course, the CEO of the bank insists that this has nothing to do with the financial health of the bank. It's just because of the overall economic conditions right now aren't conducive to giving loans, guys, which obviously is a huge lie, first of all, because many banks are being forced not to give loans anymore because they can't afford to. They can't afford to lend money out with the amount of reserves that they're being required to have on hand now. And he's saying, oh, don't worry about it, just go ahead and get a loan somewhere else, 25 of the top lenders in the country aren't banks anyways, so it's easy to still get a mortgage out there, so don't worry about it. And guess what? It's not just small banks like this Bank of New Hampshire. No. It is also big lenders too. In fact, big wholesale lenders are pulling out of the mortgage business right now. Citizens Bank, they're no longer going to be backing any more wholesale mortgage products. In case you don't know what a wholesale mortgage lender is, it's basically just a lender that does a lot of volume. So they can give better deals for people. They can give lower rates because they just write more loans. So think of it like Costco, for example, for mortgages. You go to Costco, you can buy things in bulk, and it costs a little bit less than it would at the supermarket. Same concept with wholesale mortgage lenders. Well, apparently this isn't profitable anymore, and Citizens is getting out of this business. And they are the 28th largest U.S. mortgage lender right now, and for them to decide to get out of this business is a big deal. Even for the first half of 2023, Citizens wrote about $1 billion in volume in the mortgage business. So it's not like they're a small player in this. And it's funny because if you just go back 5 years ago, Citizens was actually acquiring lenders and bulking up and building up their business because times were booming, and now they're shutting their doors, guys. In fact, back then, they acquired Franklin American Mortgage. Now they're citing the fact that shrinking mortgage volume and fiercer competition are challenging the bank's strategy, so they need to close. And by the way, they're not closing, they're just not going to be writing mortgages anymore. So in the first half of this year, Citizens originated $2.4 billion in mortgages through the retail channel, and that is a 60.3% decline from just 1 year ago. Think about that. Business is down more than 60%. That is crazy when you think about it. And remember the $1 billion figure we gave a little bit earlier of how much they had in their own wholesale business? Yeah, well, even though they wrote $1.1 billion in mortgages from January through June of 2023, that number was down 65% year over year. Think about that. A 65% drop off in business. Say any type of business you have and you start seeing a 65% drop in your business, guys, that is substantial, to the point where you might not even be able to pay your bills anymore and you could potentially go out of business. So that is a huge problem. And all this is happening pretty fast, actually, because an employee from Citizens said that at a meeting they had Tuesday last week, a meeting that lasted just a few minutes, saying that we're shutting down the wholesale division and no questions asked. That's it, guys. Like, we're finished. And this employee says that, hey, we didn't see this coming at all because we were so busy for so long. Now all of a sudden we're closing our doors. So this is going to happen starting at the beginning of 2024, which is also when these employees are going to be laid off. So they have just about a month and a half left to keep their job, and that's it, guys. Happy New Year, and now you're unemployed. And guess what? It's not even just Citizens either. It goes much further than this, because over the past 2 years, we've also seen Loan Depot, Mountain West Financial, AmeriSave, Point Mortgage Corp, and Home Point Capital all shut down its wholesale lending operations. But don't worry, guys, the housing market's doing great, even though the people that give mortgages are going out of business. So don't worry about it. Everything's fine. It's a great time to buy a house still, and there should be no worries of any sort of economic downturn coming in the future with any of this. Speaking of economic downturn, let's talk about deflation for a minute. So what is deflation anyways? Well, just like inflation means prices going up, deflation means prices going down. And not to be confused with disinflation, which means that the rate of inflation is going down, but we still have inflation, if that makes any sense. So you can just think of inflation, prices going up, deflation, prices going down. Now, at first glance and first thought, it might think like, wow, having prices going down on anything right now would be a blessing, right? Well, yeah, it would, until we look deeper into this and how it might affect the broader economy. Now, right off the bat, this is kind of good because people need to have some sort of immediate relief with prices because everything has gotten far too expensive, as we all know. And they're saying just in time for the holidays, you're going to see dairy, eggs, chicken, and seafood all come down in price. Now, personally, I haven't seen this myself yet because I just went grocery shopping like 2 weeks ago. I try to do it only like once a month so I don't spend as much, and also it's more convenient that way. So I haven't seen the prices of these items go down yet. So they're saying that the average cost of a turkey this year for Thanksgiving will be about $61.17, and that feeds about 10 people versus the $64.50 that it cost last year. So, okay guys, yeah, the price of turkey go down by $4, sure. Is that really gonna put a dent in your budget? Probably not. But it's all the things that add up, right? It's $4 here, it's $5 there, $15 there, 20 bucks here, and then you can start to see how it can really have a major impact on your monthly budget with the things that we buy on a daily basis. But here's the real problem. Deflation actually suggests a weak economy and that the economy might be in trouble. Well, why is that, Michael? Why would the economy be in trouble if prices are going down? Isn't that a good thing? Well, no. The reason why prices are going down is because the demand for all these goods and services is going down because people are not buying them. Therefore, because you have the dynamic of supply and demand and how that dictates the price of practically everything that we buy, the more supply you have of anything, then the lower the price is going to go. Same thing with when you have high demand and low supply. That's why you see the price of housing skyrocket because we just haven't had the inventory over the past couple of years to keep up with the demand. Therefore, the price shoots through the roof. And so the reason why you're seeing businesses lower prices is because people aren't buying things. And by the way, since we're on the economy real quick, I want to tell you guys a really cool story real fast. And that is, I recently talked to a high school student, and he goes to Cardinal Gibbons High School up in Fort Lauderdale. His name is Jesse, and he told me that his macroeconomics teacher, Mr. Zaslow, is a huge fan of my channel and actually uses my content to teach his macroeconomics class, which is super cool. So I want to give a huge shout out to Jesse and to Mr. Zaslow. Thank you so much for using my content to help teach your class. It's an honor to be an influence on young people and help them understand what's going on out there today. So thanks for doing that. And by the way, for all of you who are talking in the back, Mr. Zaslow is going to make you watch this again, so you better be quiet. Check this out, guys. Another downed tree. This is a monster tree. This thing is not small. You can see the roots on this thing are just huge. down for good. See you later. So here's the other problem with deflation. It's not only that people aren't buying things and so businesses need to lower prices, this also suggests that people are having slower growth in incomes and therefore cannot afford to continue buying things. Now we already know that that is true as well because wages have only gone up about 5% in the last year and the cost of living has skyrocketed far beyond that. So what you have is you have businesses that are lowering prices in response to lower demand and they're not raising their wages by much either. And the next thing that can come from this is more unemployment and more job cuts, because if business is slow, then first of all, they're not going to be giving people raises, which gives people less money to spend in the economy. But on top of that, if business slows down enough and they can't afford to keep 10 employees on the books and they have to cut it down to 7, well, that's 3 people that just lost their job and have no money to spend in the economy. So you can see how this quickly starts adding up and the amount of impact that this can have nationwide. You know, a few dollars here and there doesn't seem like a lot until it adds up to hundreds of dollars a month, and now all of a sudden you're over your budget. And there's also another problem with deflation besides just the fact that demand for goods and services aren't there and the potential job losses and business closures that can come from this. You also have the effect that it has on interest rates and loans. So for example, one thing you've probably heard by now is anybody who got these low mortgage interest rates during the pandemic and have locked those in basically have a loan now that's beating inflation. So the inflation kind of eats away at all the interest that they would have to pay over the life of the loan, because now inflation is running higher than those interest rates that they got on their mortgages. Well, with deflation, it actually works in exactly the opposite way. So you have high interest rates today, but if people aren't getting wage increases to help pay for those higher interest rate loans, it makes it much more difficult to pay off loans when we have deflation versus inflation. Because the deflation means that it is essentially stealing away more of that borrower's purchasing power each month. So basically, in the same way that inflation is good for a fixed rate loan because over time you pay less, deflation is bad for fixed rates because you pay more in real terms. So another reason why this is a problem is because you see the United States has hit over $1 trillion in credit card debt recently, which is a record, by the way. But with slower wage growth, it becomes harder and harder for people to climb out of all these debt payments. And the reality is the credit card debt is just one aspect of it. You know, people have $1,000 a month car payments now. People are using buy now, pay later to buy Christmas presents. People are taking HELOC loans on their houses to be able to have more money to live off of and pay bills right now. People are taking personal loans. Every type of loan you can think of right now, people are taking to get by on the cost of living. But the problem is that doesn't last forever, guys. Everybody gets tapped out with credit at some point or another. When you have too many loans, you can't get approved for a new loan eventually, which is what will happen to a lot of these people. And if they're using this money to survive and just pay for their cost of living, well, what happens when that money runs out and they can no longer borrow anymore? Well, you can use your imagination from there. And here's where it gets real interesting. This doesn't just apply to people, but it also applies to businesses. So when we have deflation, more of the income that that business earns is going towards paying off their debt and paying their expenses, which means hiring less people and less investing into the business to grow the business, which ultimately leads to lower job creation. So on the surface, deflation might sound like a great thing because prices are coming down. And it is a great thing immediately for a lot of people, but it can have far-reaching implications on the economy, just like inflation had on the way up. So the most recent example of deflation in recent history is Japan. And what happened to them is they faced a lost decade that started in 1991, which is when deflation was one of the economic conditions contributing to recession. And that over the next several years, this is something that the US has to watch out for. And what a lost decade was in Japan is when they had no gains in their economy or their stock market. So you could essentially put money into the stock market in Japan in 1991, and then in 2001, you still had the same amount of money in the account. It didn't grow. In fact, you probably lost money just when you factor in opportunity cost that is lost on that money from not using it in another investment. We could be next in terms of having a lost decade here. It's something that people have been wondering about for a while now. Now, one of the best solutions to this entire problem is people just need to make more money, and the more money that people make, the more they'll spend in the economy. Sounds easy, right? Well, obviously it's not that easy, because if it was, then everybody would be rich and everybody would have a ton of money and savings and have no financial woes. And I'm sure everybody's heard that saying that money doesn't buy happiness, but it actually does up to a certain extent, because if you're broke and you can't afford to have a good life and just pay your cost of living, then life is going to suck. But if you can make enough to pay all your living expenses and enough to still have some fun and enough to invest and put away for your future, that can significantly contribute to someone's happiness. Well, there's a company that's a financial services company called Empower. They did a survey recently of 2,000 people. The people who answered the survey had a median salary of about $65,000 a year, said that they would need to make $95,000 a year for them to be happy and less stressed out. And the highest earning people in the survey made about $250,000 a year, said that they would need to make $350,000 a year to feel the same level of happiness. Now in 2024, the average employer is only planning on giving their employees about a 3.9% raise. So you can see that is nowhere near what most people would want to see in order to have their level of happiness go up. And according to this survey, most of the people who answered said that they would need to see their income go up by about 50% to see a noticeable increase in their happiness level. Also, about 70% of the people surveyed said that having more money would solve most of my problems. Now, I think that's largely true for a lot of people, because most people's problems stem from some sort of financial issue. But the problem is that if you don't have any sort of financial education or any sort of foundation built on what to do with money when you come into it, that's where most people run into trouble. Because in order to be able to sustain yourself from making more money or getting a raise or coming into, a lottery windfall or anything like that, you have to know what to do with that money. If you just go out and buy a Lamborghini and think that you're going to be happy after that, it's not going to happen, guys. Well, now you don't have the money to pay the crazy high Lamborghini car insurance or pay for the maintenance on a car like that, and constantly be putting gas in it. And so eventually you run out of money, you lose the Lamborghini because you can't afford to maintain it anymore, and you learn one of life's hardest lessons, which is that it doesn't matter how much money you have, if you spend it all, you have nothing. But people need to learn how to hang on to the money that they do make, learn how to invest it wisely, and learn how to make that money work for them and grow eventually. But the most interesting thing about this whole survey to me is that no matter how rich people were, they always wanted more. And I guess that's just a part of human nature, and ultimately what causes so much greed in the world, because they talked to people that had a net worth of over $10 million, okay? Because in a separate study back in 2018, they asked millionaires to rate their level of happiness, and they talked to people who had over $10 million of net worth. They asked them how much net worth would they need to have to be happier, and a bunch of them said 50% more. So you need to go from having 10 million to 15 million to feel happier, guys. And then once you get to 15, it needs to be 20 or 25. Like, it literally never ends. So I'm not saying people shouldn't be ambitious. I'm not saying people shouldn't always strive to have a better life and always earn more. But I think it comes to a point that if you're meeting your expenses, no problem, and if you're able to invest money, no problem, and still have money left over on the side after that to do fun things, to take a trip once a year, to do stuff that makes you happy and not feel like you have to worry about the money, then I think you're doing much better than most people. Because a lot of people right now, I mean, the latest numbers just came out, guys, that 60% of Americans right now are living paycheck to paycheck. That's as of the most recent data. So that's more than half. Do you have this situation that I just described where things are going pretty well? Then you're ahead of 60% of everybody else in the country. So you should start feeling good about that and just look at small little ways you can improve from there. If you guys enjoyed this video, make sure you subscribe to the channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.